Good afternoon, everyone, and thank you for joining this week's live product walkthrough and Q&A session. My name is Dan. I'm a Senior Customer Success Specialist here at Snap. And today I thought we would go over some of the frequently asked questions that we receive on our team from you, our clients. So let's jump in. Now, in regards to any questions that you may have, please feel free to submit those. You do have a Q&A window within your Zoom. If I don't get to your questions by the end of the presentation, just be assured that I will be following up with you shortly after the presentation today. Okay, so I'm going to hop over into our Snap. So one of the common questions that we do receive is what information do I need to start or create a projection? So I'll refer you over to our Help Center. And there's a Start Here module. And it would be within the Snap Projections Toolkit. So there's a couple of things I would want to point out here. So we do have financial planning questionnaires. We do have a short version and a long version. The only difference would be the long version does include a corporate component to it. So if you do have corporate clients, there is a section to fill out there. And the short would just focus on personal assets. Just moving down, we also do have a relatively new financial planning checklist. So once you're able to gather the information using the financial planning questionnaire, this is a step-by-step guide on what you need to kind of focus on when you're in Snap and setting that client up. There's also some sample reports within this toolkit. So when you're actually building out your report after, which would be the final stage in your projection, you do have a sample, again, a short and a long version of a sample report that you'll be able to refer to, available both in English and French. So I'm going to go back now into Snap. So you can see here, I currently have all my clients hidden. You can do so by selecting the menu button up here to show all clients, or you can hide all clients. And I will pull up the sample client that we're going to be currently working in. And that would be Dale Smith. So when you create your first scenario, it's going to be titled most likely base scenario. I've labeled mine sample scenario, as you can see up here. And a lot of our clients want to know how can we rename the scenario, just so you can become familiar with perhaps some of the changes you've made in that plan. So you can do so by a couple different methods. You can simply click on the title of the scenario and you can relabel it. I'm just going to relabel it base. I'll hit save and you can see the title has changed. You can also click on the menu item here and select rename scenario, and it'll bring you into that same window. You can make your changes and hit save. Another question that we get in regards to RRSPs and TFSAs is how can you set up contribution room? And if there is a employer matching program, how do you address that? So you can do that within scenario setup under the assets, and there's a couple different ways you can reach that page. You can simply click on financial assets, and you can see it brings you right to scenario setup assets. If I hop back into the planning pages, you can also hover over scenario setup and go down to assets. So under the assets, there are a couple different subheadings here. So you can see TFSA and RRSP, and there is an employer matching. So starting with the TFSA, by default, Snap will assume the contribution room for the plan start year will be the annual maximum, which is 7,000. However, If your client has any unused room, this is where you would come in and update that figure. I'm going to go over to RSPs, and we do have the same thing. So by default, SNAP will update this figure to be 18% of the client's income up to the annual maximum. But again, if you have any unused contribution room, you are able to come in here and update that. And a couple other things, the base minimum RRIF withdrawals off of the younger spouse. So if you want to do so, in this case, we don't have a spouse added, but if there was a younger spouse and you want to reduce the income based on the spouse's age, this is where you would come in and check that off. There is a conversion age, which I'll touch on in a bit later on in the presentation. And then finally, in regards to employer matching, let's assume that this RSP was a group plan and the employer was contributing to it. You would come over and you could select base the contributions on the employment income. The two windows here would be unlocked, and you can specify a percentage that either the employee and or the employer are contributing to that plan. Now I'll leave that unchecked. Another question is, how do I maximize my TFSA contributions? So there's a couple different methods. There's a manual method, which I'll show you in a little bit. But going back over to our TFSA subheader here, you are able, and this is relatively a new feature that SNAP has introduced within the last few weeks, you can check off maximize the TFSA contributions for this scenario. And if you scroll over, you're going to notice question marks throughout SNAP. But if you highlight this, it gives you a little bit of a breakdown on what that is referring to. So this would use personal cash and non-reg assets to maximize TFSA. So if there are non-reg assets or personal cash, SNAP will automatically use that to top up the TFSAs year over year. For now, I'll leave that unchecked, and I can show you the different way to maximize your TFSAs if you prefer a more manual method. So you can see here I have entered TFSA contributions, not the maximums. So these are my overrides. However, if I want to max out the TFSA, and I'll still copy it down to 64 for this illustration, I'm going to enter 15,000 per year. Now, SNAP is smart enough to know that that cannot be possible if the current maximum is 7,000, which we've left under the TFSA settings. But if I go to run this scenario, you can see here it's corrected itself to do the 7,000. And then year by year, it will slowly increment it up by the closest 500. So that's another way that you could enter the contributions yourself if you chose to, or there is the automated method that I previously just showed. For now, I'm just going to change this back to my original 3,000. Again, I'll copy that down and I'll just refresh my plan. Now, another question that we get is what are the base expenses? So let's hop back into scenario setup. Again, you can go directly there by clicking on expenses. And here you can see our base expenses. So base expenses is what we're looking for is for you to enter what the client would like to spend in retirement after taxes. So again, just highlighting the question marks here. So these are lifestyle expenses like groceries and travel expenses. And then the additional expenses is anything outside of the base expenses. So let's assume we're going to add some in. And I'll do two examples. So let's do a one-time renovation expense. And I'll say 15,000. We'll leave that indexed. And let's assume that he's going to do that in the first year of his retirement. So he is retiring at 65. And we're going to run it to age 65. If I left this blank, it would run each year throughout the life of the plan. So we just want to stop that. And then going over here, let's assume also a vacation expense. And let's assume that's 8,000. Again, it's going to start in the first year of retirement. And we're going to run it to age 80. But perhaps they're not going to spend the 8,000 every single year. You do have the option to come over to the frequency section here. And we're going to say every other year is something that would apply to this client. Now, if I go over to the planning pages, again, we have our base expense of 54,000. We now have our renovation expense indexed out, and we also have our vacation expense occurring every other year up until age 80, and then that stops moving forward. I'll remove these for now. Now, another question is, what happens if there is a shortfall in the plan? So I will go in here. And excuse me, there's a couple different ways you can update the base expenses. You can do it from the scenario set of expenses. You can also override these cells by clicking on the base expense. I'm going to increase these to 65,000. I'll copy these down for the life of the plan, and I will run that scenario. So if we scroll down, we can see there's this red or pink section, just indicating that there is a shortfall in the plan. We can also see there is a negative net cash flow that is accumulating over the life of the shortfall. And if we scroll over to the financial assets, we can see the value of the RSP, the TFSA, and the non-reg investments are completely depleted to zero, just indicating that there is now a shortfall in the plan. So there's a couple different ways you can address this. You can, of course, reduce the expenses manually, or we do have a recommendation here called the sustainable spending recommendation. So that will find a consistent level of spending year over year, starting from the CFM start age, in this case, at age 65 when he retires, and not run out of funds by the end of the projection. But in this case, let's assume that he does want to spend the 65,000, and let's say he wants to spend that for the first 10 years in the plan. So you can actually run the sustainable spending at a future age. It doesn't need to start at the CFM start age or at retirement. So in this case, let's run that until he is 74. I'll hit save. Now I'm going to calculate what the new sustainable number would be starting at age 74. And the answer here is 58,631, which is 6,369 less than our current 65,000. Now, before applying and running it, what we always recommend when you're calculating any of these recommendations is you make a copy of the scenario first. So you don't want to lose your original copy. It's hard to revert back to. So let's make a copy, and then I will apply and run that. Perfect. So now you can see here the 65,000 running for the first 10 years in the plan. We now have our new sustainable spend number running until the end of the projection, and we don't see any pink. And if we scroll over, you can see that there's little to no assets left over in the RSP. The TFSA is completely depleted, and the non-reg is completely depleted. What's left over is the real asset, his home. So that is not taking into consideration when running that recommendation. Snap will not assume that the home's being sold to come up with the new base expense number. So I'm just going to go back up. I'm going to change this back to our original 54,000. I'm going to copy it down. Perfect. And what I forgot to mention is that once you hit apply and run, it will bring you into a new copy of that plan. Since we checked it off, it will label it as a sustainable spending scenario. Again, you are more than welcome to come in and you can adjust that title, perhaps to just sustainable spending. And there we go. So now how to copy a scenario. So first I'm going to show you how to switch between scenarios. So I'm going to go back into our base scenario. Now this is where I want to change the 54 to go back to our original settings. I'm going to run that. Terrific. So to copy a scenario, you can go up to our menu line here. There is the copy option. It will now say base and then copy. So I'm going to want to show you our compare scenario feature. So I'm going to change this to the changes I'm going to make in this particular projection. So I want to compare the original projection, which he's going to be taking CPP at age 65, to if he took it at age 70. So I'm just going to update that, just so I can remind myself this is the one that he's going to take at age 70. I'm going to hit save. The name changes. I'll now go into the government benefits and make those changes. So instead of age 65, I'll hit age 70. The pension amount will update to the increased amount since we are now taking it later. And I'll go back up to our menu. And now I want to compare those two scenarios. So I'm going to go to our base scenario and the new one at age 70. I'll leave the sustainable spending scenario out, and I'll hit compare scenarios. Okay, so we have our base when he's taking it at age 65. We have our second scenario, him taking it at age 70. And there are different metrics throughout the compare scenario feature to help you see which is the optimal version. And the final column here would be the difference. So in regards to goal progress, based on the level of spending, how many assets or how much is left over at the end of the projection, less any debt. So in this case, he would be 125% versus 118, the difference being 7%. There are different metrics where there are no changes. We didn't change the retirement age. We didn't change the end of the projection. We didn't change the level of spending or lifetime expenses. But however, you can see here, there is a difference in the lifetime personal tax payable. So in our second scenario, taking it later, he would be paying 130,000 roughly more in taxes over the life of the plan. The lifetime government benefits that he would receive for taking it later is going to be roughly 394,000 more that he would be receiving over the course of the projection. And because of the increased benefits, he's actually preserving more of his financial assets compared to the first scenario by around 351,000. The real assets we did not touch, so that's going to be consistent. There is no difference. So the total still being the difference in financial assets. And if we scroll down to the estate before tax, you can now see the increase in financial assets, the tax on estate. So he's paying slightly less tax on the estate, and the estate after tax. So he ends up with an estate after tax of roughly 353,000 by taking CPP at age 70. So that helps you, again, find what is the optimal scenario. Now, keeping in mind, this is running for the life of the plan. So to age 100. So if we wanted to perhaps pick a more realistic life expectancy particular to this client, and let's assume 82. Let's save that. So this is now running it from 2025 this year until age 82. And now we can see the difference that that would make in the plan. So again, in this case, he will be paying more taxes. He will be receiving more benefits, but actually the financial assets, he's in a better position if he were to take it at 65, if we're assuming this runs until age 82. And then again, the estate after tax, it's actually more beneficial for him if we're running it to age 82 to stick with the original scenario of taking CPP at age 65. The other thing that I really enjoy about, and I'll change this back to 100 for now, about this is there is a trends option. So if we're solely focusing on the estate after tax, so you can see the difference, the different metrics, but let's focus on the estate after tax. So you can see here, year by year, you can compare the two scenarios. And it looks like around age 83, they're very similar. But then at that point, our second scenario begins to become more beneficial. And before that, it's our initial scenario that would be more optimal. So again, I think this is very helpful to come in and pick a year and see exactly where the client would stand. Now, all these metrics you can see, for example, the corporate, there are no corporate assets in our projection. So you can actually take out those metrics by clicking down here. Let's click the header for the corporate assets. It will remove all the corporate metrics. We can then say show selected metrics. And you can see now the corporate metrics are completely removed. You can also come in here and unselect any of the personal metrics if you don't think that's beneficial for your client. For now, I'm going to go back in and I'll just add back in the corporate. And you have the option of exporting that out or printing that off for your client as well. Okay, so I'm going to go back into the base scenario. So I'm going to switch by clicking on the client's name. You can hop back in there, or you can simply go to the menu and switch back to the base. So the next thing I want to discuss is the CFM order. So the cash flow management order for contributions and withdrawals, which would start at the CFM start age. So in this case, at age 65 when he retires. So to show that, you could go up to the financial assets. I'm going to click on show the CFM order column for this scenario. I'll hit save. You can now see there's two new columns that show up, contributions and withdrawals. So at the beginning of the CFM start age, if there was a surplus, of cash, Snap will want to contribute that to the financial assets in a particular order. The default order would be to RSPs if the RSPs were maxed out, or if they were in RRIF mode, obviously you can't contribute to it. It would then be moved to the tax-free. If the tax-free savings did not exist or was maxed out, it would then want to put it into a non-reg portfolio. Now, on the flip side of that, if money was required to come out to meet lifestyle needs, for example, it would come out in this particular default order, starting with non-reg, tax-free, and RSP. So if the non-reg was depleted or didn't exist, it would take it from a tax-free account. If that was depleted or did not exist, it would then take it from an RRSP. Now, both of these can be updated to your preference. You can do it in just one given year, or you can copy it down for the life of the plan. And again, this is a great example where you could use the compare scenario feature. So you can make a base case with, let's say, this order of withdrawals. You could then switch it by coming in here and switching the order, for example, to registered, non-registered, and then tax-free, and then compare those two scenarios. So again, I always recommend build your base case, make a copy, make your changes and then compare them to see the impact that those changes make to the plan. So for example, you can see here, the withdrawals are occurring with non-reg first, and then registered, and then I don't think we even take out any monies from the tax-free. We're not required to, but if we were to switch this order, which I'll do here, I'll switch it to registered, non-registered, and tax-free. I'll also copy it down for the life of the plan. We can now see the order's been changed. I'm going to run the scenario. And you can now see the RSP is actually kicking in first. Once that's been depleted to 0, this is when our non-reg withdrawals begin. And again, in the final year of the plan, once that's depleted, there is a small withdrawal from the TFSA. Now I'll switch this back to our default. I'll run that scenario. So you can see here, the RRIF income doesn't begin until the final year when it would have to at age 72. But since he's retiring at age 65, maybe it would make sense to bring in that RRIF income a bit sooner. So what I'll do in order to do that is go back into our financial assets. I'm going to go back to our RRSP RRIF tab. The conversion age you can see here at 71. So if we want his income to start at age 65, we always want to input the year prior to convert the account over. So it's the conversion age, and then the income starts the following year. So in this case, we'll update that to 64. I'll go back to our planning pages. You can now see here that the income begins to be taken at age 65 from the RRIF account. This helps offset the withdrawals from the non-reg portfolio. Another thing is you can hover over both TFSA and RSPs to see what the minimum withdrawal amount is. So you can confirm this is the minimum withdrawal for that year. You can also see any contribution room that would be outstanding. And then for TFSAs, again, you could hover over the figure and see what is the contribution room. And again, that will change year over year. So a couple other things before I let you go is these table icons on the planning pages provide a bit more detail for you. So for example, for taxable income, it provides a breakdown of the taxable income year over year. So in this example, taking into consideration his employment income, less any deductions he would be eligible for, plus we have some RSP contributions occurring, his investment income in his non-reg portfolio to come out with the total taxable income. There is one for total tax as well, which breaks down the federal and provincial amounts. We also do have one over here for the estate before tax. So this is the final year in the plan. It provides a snapshot of the financial assets, the real assets, the home for total assets, less any debts. He doesn't have any debts in this case or insurance proceeds. So the estate before tax, the tax due on the estate, and then the estate after tax. But again, if you want to get a snapshot of any given year, you would go down that column. Let's use our same example from comparing the scenarios at age 82. And you can see exactly what that estate would look like at that specific year. And again, the question marks that you're going to find throughout SNAP are also included on the planning pages. So if you're ever in doubt with what that column means or what a field means, you can hover over that and it provides you a bit more detail on what SNAP is looking for. So again, I can't highlight our Help Center enough. Again, you can access it once you're logged in by going to Help Center. So if there is anything specific that you are looking for, so for example, if you want to add a corporation, there are step-by-step guides and videos on how to do so. If you had to add any insurance policies or you want to run a life insurance needs analysis, again, there's great articles in there providing you with those step-by-step guides on how to do so. You can also search for something specific and it will pull up any article based on those keywords that you enter. So a great resource. In the event you can't find what you're looking for, that's why our team is here. So please reach out to us. We're here 9 to 6, Monday to Friday, Eastern Standard Time, or you can hit this contact over here, provide your details and the question, and that will go to our general mailbox, and we're more than happy to jump in and help you out. We try to get back to everyone within 2 hours. So if we don't pick up, please leave a voicemail. And again, we try to get back to everyone as quickly as possible. So in short, that's what I wanted to cover today. We kind of went over some of the common questions, some tips and tricks, again, highlighting our help center. So with that, I'll let everyone get back to their day. I really appreciate you joining, and hopefully I'll see you at the next session. Take care.